two dividend stocks, one with a yield of 3.07%, another with a dividend yield of 5.31%. Which one is the better dividend stock to buy? That's what I'm going to answer in this video, comparing Ford Motor Company with Coca-Cola stock and answering which one is the better dividend stock to buy. So let's jump right in. Let's look at the factors that are worth considering when making this decision.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So of course, one of the first things that passive income investors look at when they're looking at a dividend stock is the dividend yield. Ford Motor Company offers 5.31% and Coca-Cola offers 3.07%, as I mentioned earlier. But that's not the only thing to consider when you're investing in a dividend stock. In fact, it's actually one of the lesser important things to consider when you're thinking about investing in a dividend stock. Some of these factors I'm going to discuss after this one, I think, are more important than the dividend yield because they could have more to do with your total return than the dividend yield does. So let's look at some of those things. Starting with the dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. Okay, so now that you understand the importance of the dividend payout ratio, let's look at Ford and Coca-Cola. You can see Ford with its fluctuating earnings per share in the orange here, going up above the dividend per share for most of the last decade, for most of the last 5 years, I should say, but also dipping below dividend per share briefly in some moments as well. Meanwhile, Coca-Cola comfortably above the dividend per share is its earnings per share in the last 5 years. So while Ford offers investors a better dividend yield, Coca-Cola offers a more sustainable dividend yield and more of an opportunity that it will increase its dividend per share over the next few years because it's got room to increase its dividend per share and still stay below its earnings per share. it's a factor that's important to consider. The next thing I wanted to compare and highlight between Ford and Coca-Cola is the operating profit margin. Over the last 10 years, Coca-Cola's operating profit margin has been well above that of Ford. In the most recent trailing 12 months, Coca-Cola's operating profit margin held at 28.45% compared to just 4.17% of Ford. Now, over the next year and 2 years, I suspect Coca-Cola's lead in this metric will expand. Why do I say that's the case? Well, consumers are unleashing pent-up demand for away-from-home activities like going out to restaurants and theme parks and movie theaters, etc., etc. These are places where you're more likely to find a Coca-Cola beverage. Coca-Cola has exclusive relationships with restaurants that have it taking a significant market share of the away-from-home segment. Think of its exclusive relationship with McDonald's. When you go to McDonald's, you find Coca-Cola, you won't find Pepsi. And so if you're going out to eat, if you're eating away from home, more likely that you're going to purchase a Coca-Cola beverage. And the opposite is true for the Ford Motor Company. In the last 2 to 3 years following the outbreak of COVID-19, those supply chain shortages were favorable for Ford. The auto industry worldwide decreased production, decreased supply, and focused on the most profitable vehicles, including Ford. And that meant that the negotiating power shifted to manufacturers like Ford because customer demand was still strong, but supply decreased, which increased pricing power for companies like Ford. And that scenario is not long lasting. That scenario is reversing as the supply chain constraints have eased. Supply chain problems are almost eliminated. There are still some supply chain issues around, but for the most part, they're nowhere near the levels they were at in the earlier stages of the pandemic. So supply is increasing, and that imbalance is going to create less pricing power for Ford. And so profitability is likely to have peaked for Ford at around this level for the near term, especially because Ford is investing billions in the transition to EVs, which is weighing on its profitability in the near term as well. Not to mention the deal with the UAW, which is going to have it paying higher wages to nearly all of its workers. So for all those reasons, Coca-Cola's profit margin lead against Ford is likely to expand. The next metric I'm going to look at is revenue, and you can see Ford's excellent prospects in this metric. Look at how revenue has expanded for Ford in the last couple of years because of those factors I mentioned earlier. However, I wouldn't be surprised if this levels out and stays flat over the next couple of years for Ford, while Coca-Cola's revenue continues to increase higher over the next year or two, up from its current 45 billion level. Additionally, Ford's revenue is more cyclical than Coca-Cola's revenue. If you're about to lose your job, you're not going to go out and buy a car, or if you're at risk of losing your job, you're not going to go out and buy a car, whereas your job prospects are not going to change your beverage consumption behavior all that much. Maybe you don't go out, maybe you don't go eat out as often, but it's not going to change your behavior all that much in terms of your quantity of eating out. Maybe instead of eating at Olive Garden, you go to McDonald's instead. But you're still, if you eat out twice a month or 3 times a month or 5 times a month, whatever it might be, you're likely still to eat out that many times, but at a lower priced establishment. And finally, valuation is important to consider because you don't want to pay too much for a stock. Coca-Cola is trading at a forward PE of 20, while Ford is trading at a forward PE of 6.5. Still, despite Coca-Cola's more expensive valuation, if I was a passive income investor, I would pick Coca-Cola as the better dividend stock to buy. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.